Bonds. This is a video topic that I've wanted to do for a long time. Bonds are part of my asset allocation, and I don't hear that many other YouTubers talking about this topic, so I thought I would just share a little bit of what I've learned. I'm mostly influenced by the fact that my bonds have not been performing very well lately, and I wanted to take a look at the underlying reasons for that and figure out if this strategy of incorporating bonds into my mix is actually working out for me. So to do so, we're going to look at what a bond is and what is the relationship between equities and bonds. How's it going, everybody? I hope you and your investments are doing well. My name is Steve. I'm a dividend stock investor using Wealthsimple Trade to put $150 every week into my tax-free savings account, which you can follow along and check out my progress. As well, using Wealthsimple Trade, I am purchasing bonds, which I put into my RRSP. And it's bonds that we're going to talk about today in this video. I first want to give some credit to Accidental Fire and JL Collins for writing on this topic back in November 2021. Just days apart, actually, where they do a great analysis of the diversification report that came up by Vanguard. I've put links down below. But that is some of what we're going to be talking about today, so check out their work and give them some support. What is a bond? Simply put, a bond is when you lend your money to a borrower for a fixed period of time, usually short or long, and there is a guaranteed return on your investment, often called a coupon. So for example, if you lend $1,000 of your money and they promise to give you by the end of the year $35, the interest rate is 3.5%. Now, if the interest rates overall go up by 1% and they're now 4.5%, someone who wants to make $35 only now needs to invest $778 to make the same return as your $1,000 bond. So that is why when interest rates go up, the price of bonds go down. And as we know, the interest rates right now in the United States and Canada are at record lows, so they're only going to go up in the future. And we're already seeing the increases this year, and we know there are promises of further increases to happen as it is one of the ways that we're fighting inflation. Which leads to the main argument. Are bonds a wise investment in a low interest environment? And a study by Vanguard on diversification looked into this, and they simply put it this way. This is from the introduction. The main concept underpinning the equity bond portfolio is the idea of diversification. While equities typically offer higher returns over time, bond investment properties make them an excellent tool for reducing risk. However, in recent times, investors have become more concerned about the effect of a low interest rate environment on the role of bonds in a portfolio. Since increases in interest rates result in bond price declines and rates are at historic lows, the worry is that bond instruments can only fall in value. If that is the case, then why hold fixed income in the first place? I think this would leave many of us hesitant to keep buying bonds or even start buying bonds, even though it's probably a smart idea to keep buying them if it is part of your asset diversification plan. So in my case, I am trying to keep roughly 20% of my investments in bonds. And right there, I think is part of the semi-solution there, having a diversification plan. So I have to take a look at that and remember, okay, why did I start up a plan in the first place, which is always a great idea. And the main thing for me was to help mitigate risk. Vanguard in the report says it nicely this way. One of the key properties of bond, they act as a hedge against equity market drops. And protecting myself from extreme risk was one of the main reasons why I modeled my investing strategy after Ray Dalio's all-weather portfolio. Now, I am not recommending this portfolio at all. This is not financial advice. And I will not know if this entire plan pays off for decades, like many of us. Why are bonds a hedge against stock market declines? We can simply put it like this. When stock values drop, investors don't want to lose that value. So they start looking for other ways to park their money in ways that are guaranteed to keep making them money. And bonds offer a safe vehicle for their money because the whole point of bonds is that guaranteed return, that coupon that you would get. And if the bond percentage rate is higher than like the current stock return on investment, then bonds are an attractive vehicle that they want to put their money into. And I know recently that didn't seem to be the case when stocks and bonds both recently dropped significantly at the beginning of the pandemic in March 2020. But that's what Vanguard calls market noise. It is something to be completely ignored. That is something that is outside of the normal operation of the market, which simply, again, put, is equities go up, bonds go down, equities go down, bonds go up. So it's very, very important to ignore any of that market noise that fits out of that normal pattern. And you need to rely on just trusting that investing in bonds is a time-proven strategy to protect against major stock market drops. Individual bonds versus ETFs. So at this point in the video, I'm hopefully convinced you that bonds belong in your portfolio, not always as a growth position, but as a stabilizing position. So it evens things out in the worst of times. But now let's take a look at individual bonds versus ETFs. Because a lot of the talk about bonds is usually at the individual bond perspective, where there are a lot of great bond ETFs out there that are available to buy. Now, the good news, though, for people who are buying individual bonds as the interest rates are going up, you're able to take advantage of those. If you're holding older bonds, not so much. The value is dropping. But it's also very, very important to remember that part of the reason why people buy bonds in the first place is because of the fixed income that they offer. That is never jeopardized. J.L. Collins makes a great point in his blog article, which has put my mind completely to ease when I'm purchasing bonds as ETFs, where he says simply, holding bonds in an index fund means it holds thousands of bonds maturing at different times, and as inflation drives up interest rates, they'll be buying those higher interest paying bonds. So goodbye to all the major concerns that come with individual bonds. Now, while investing part of your portfolio in bonds does mean, therefore, then you are missing out on growth potential that equities clearly offer over bonds. So this is something you always have to kind of take in consideration, depending where you are in your position in life, when you're starting, to figure out when exactly you would want to introduce bonds into your portfolio. Thanks again to Accidental Fire and J.L. Collins for exploring this topic in their blog articles. Let me know in the comments if I have piqued your interest at all about bonds, and that's some kind of conversation you want to keep going in the comments section. If you are curious more about the all-weather portfolio, I made a video here which shows how I'm using it to kind of protect me against stock crashes and just how I chose that my asset allocation. Be sure to check that one out. And as always, keep it in the green. See you in the next video. Stay safe and have a great day. Take care. Bye.